Before our official presentation, let me make a brief introduction of our speakers. Brandon is from Camino Finance, and I have reviewed Brandon's blog about the mathematical details. So I'm impressed by their project idea on their PMM because Camino Finance is built on Solana. We can see many rumors on Solana, right? Yeah, because FTX collapsed and Solana DeFi will collapse. But from the Camino Finance innovation, we can see some strong power from Solana DeFi ecosystem. And we know the Ethereum also is died, and another Ethereum will go live. So even with such the background, and there are some new mathematical innovation on Solana ecosystem because in the Solana ecosystem there will be the order book combined with AMM like the Radium. So how about optimizing the discrete and the liquidity service using some new idea. So I think Brandon will have a beautiful presentation because I know he is the right hand also from of the blog. Yeah, of course, Jimmy, and their DEX is built BNB chain, right? Yeah, your first plan is on the BNB chain. And what impressed me that because in the last conference I had talked with Uniswap, we have talked many AMM formula details, but all those discussions the continuous function. Yeah, but I know your paper is about the discrete function, the discrete model. Yeah, I think it's also an interesting view about a discrete function because in the continuous function there are many beautiful function features. We can use the statically convex function. We can use many mathematical tools. But how about the discrete function? I think Jimmy will have his better speech. And Bowen is from Smart Lab. We know Bowen built his first DEX on ETH. It's DDEX. Yeah, he's a really OG on DeFi. So I think Bowen will be the best host of this conference. Yeah. Okay. That's my introduction of all the speakers, and I think following you introduce your guys a bit. Yeah. Okay, Brandon, you can start your introduction now.
All right, hi, I'm
Hello, Brandon.
Hi, I'm a content core contributor at both Hubble and Camino Finance. And yeah, I want to talk about the essential differences between what's the constant product market maker, what we consider the traditional market maker or automated market maker, and the concentrated liquidity market maker. So I'm going to share my screen and we'll get to it. There we go. Okay, so in this talk, I'm going to talk about what are CPMMs. They're also called many different things, so constant product, constant price, constant function, but I'll refer to it as a CPMM. The pros and cons of CPMMs. Then we'll go into what are concentrated liquidity market makers. They're also called CLAMMs. All this stuff's so rather new. We're not really standardizing it yet, so you see it written different ways in different places. So the pros and cons of those, and then we'll do a little demo looking at the Orca user experience versus the community user experience, which is essentially the unassisted concentrated liquidity from the liquidity provider's point of view on both of these, and then a Q&A. Okay, so constant product. It's first mentioned in a Reddit post by Vitalik, one of the co-founders of Ethereum back in 2016, because there is a major problem about how to trade assets on chain. The compute necessary in order to have bids and then execute a transaction is enormous, and Ethereum could take 15 minutes to execute a transaction. They could get kicked back, and the network saw too much traffic with, crypto kitties even, like you couldn't really have like a lot of traffic on the network. So It was refined and released essentially with Uniswap. So it had a version 1 that was pairing assets with ETH, and version 2 that paired assets with USDC. Now the pair is necessary because it's, first of all, like you have the quote token, which is mentioned second, that is in all sorts of finance and especially Forex. It's how the first token is priced. And in this constant product function, you get 2 assets and you start off with an equal value of both. And as you take out one of the assets, it becomes more rare and more expensive, and the other one, because it's less rare, becomes less expensive. And this is a way that you can constantly have the price reflected on chain without having to look at an order book that's going crazy with lots of different transactions. So the transactions for essentially being a market maker on an automated market maker, it's one deposit, and then the function that it runs the automated market maker takes care of pricing, and it also essentially auto compounds your fees because the liquidity pool fills up with fees. And another interesting thing it does is it gives you an LP token that you can use for borrowing or yield farming, and so this increases the composability of DeFi. It's one of those beautiful things about the rehypothecation of assets entirely on chain. You don't have to track down where the assets came from and what they're doing. Everything can be unwound like automatically, which is some kind of like step forward considering how much rehypothecation is done in traditional finance, but something could be passing hands 20 times and no one knows really like who owes what anymore. So one con about this is that they're highly inefficient. That's because the functions that help price these automated market makers is relying on a curve, and as you move along this curve, it changes the price of one asset versus the other. Now the problem is that this curve goes from 0 to infinity, and in order for the market maker to work and supply tokens, it has to do it at every single price point on that curve. So let's say if you add 10 tokens and you have spread 10 tokens from 0 to infinity, well, the price might really be something around $10. The stable swap invariant, something that came out in Curve's white paper, kind of helps solve this problem by having less price movement, but it's still bound to the same kind of principles of liquidity from 0 to infinity. If you look and see like the blue line, that's a stable swap, because that for the market taker, the user trying to make a swap, they're the most affected by slippage. So the price will change during their trade as they're affecting it with their own trade. They're moving the market, so you have to make smaller trades, and that's not the best for moving mainstream, or like somebody who's kind of new at this but wants to put in decent amount of funds. They'd be moving the market by 2% and getting 2% less tokens that they really wanted to if they don't pay attention to price slippage. So yeah, you need a lot of tokens in the pool to avoid price slippage, because again, they're being spread from 0 to infinity. And yeah, that means liquidity providers could use their tokens for other things. Most of the tokens that are being provided for liquidity are not going to be traded or used. So they're just kind of there at the edges holding tokens together at the price that's currently being quoted. And for stablecoins, this means that about 99% of the stablecoins provided just will never be used, because the price theoretically never goes outside of a very small range. So for capital efficiency, they score incredibly low points, although they were the first kind of on-chain trade and on-chain settlement at the same time kind of like solution. And then it's a form of dumb liquidity. So this is one of the virtues of the like constant product like market maker, is that you can just deposit to assets and everything's taken care of for you. You might have some capital efficiency, but you're always market making, you're always in the game. But it's a kind of spray and pray. Like you're putting in a lot of tokens and just hoping that essentially you'll be getting like your fair share, or that it's worth it to be market making in this way. Versus an order book, you can see what other people are bidding at and what asks are there. And you can see where liquidity stands in volume. And this, you're just kind of dumping into a pot with everybody else and hoping that you get back a certain amount. And all assets are kind of treated the same. Yeah, you just put them in. You can deposit and withdraw. Essentially, that's it. There's not much choice in what you can do to kind of give yourself an advantage in market making as a liquidity provider. So for users who want to take liquidity, it's difficult to avoid slippage, and for liquidity providers, it's difficult to really gain an edge or maximize capital when you're trying to actually earn fees. So with concentrated liquidity, it introduces price ranges to liquidity provisions, and a simple way to think about that is it's through ticks. So an order book is divided with ticks, and a concentrated liquidity market maker is like a bunch of constant product market makers in a row, and each one is a tick. And so they can fill up and empty rather quickly and move along. And this creates deep liquidity rather quickly. So you can provide fewer tokens and get similar results from a traditional automated market maker. So LPs, liquidity providers, can earn more with less tokens. It's because let's say if you provide 100 tokens across one tick, that's like $10 to $12. Then all trades between $10 and $12 will be exposed to 100% of your tokens. But if you say do two ticks, so $10 to $12, $12 to $14, you'll have 50 tokens essentially in each tick. And that means you'll have that much more exposure than if you had 100 tokens spread from $0 to infinity dollars. And you're only getting exposure for a fraction of your tokens. So market takers also see much lower slippage. I think at one point you could swap about 2 billion of DAI for USDC without any kind of slippage on Uniswap v3. That was incredible because, well, that's just unthinkable in DeFi. But yeah, you get an incredible concentration at a certain price. Well, then that means there's all those tokens available for trading, and it doesn't move the price itself. Remember, you got to remember that automated market makers are essentially just like working without. There are some exceptions, but they're working by themselves to find the correct price to quote. And arbitrageurs essentially help do that because they'll find the price is too high or too low, and then they'll fix it by arbitrage, and that keeps a trade constantly active. But if you have plenty of liquidity concentrated at a current price, then everyone's happy. Market makers earn from trades, and traders can trade at the great price. And positions are also highly customizable because you're not just dumping your tokens into one bucket with everyone else. You can set multiple positions, like an order book. You can choose, what is your bid, what is your ask, by setting a lower and an upper price. Some cons is that managing concentrated liquidity positions is difficult. If you see if the price comes outside of your price range, you are no longer earning fees from trades. You're no longer market making. So you have to be on top of it. If you set your price too wide, you might not earn enough because you're almost just setting a price like a constant product, a market maker. And if you're doing it too narrow, you might have to rebalance your position too often and trying to figure out which is the best. I mean, there's the option to like do lots of experimentation, but at the same time, it's like becomes a full-time job to manage a position. Another thing, there's no composability for the receipt tokens from concentrated liquidity. It's not a fungible LP token that you would receive from a CPMM. It's because the NFT has to record much more data about like the specific position that you put. It's not just a position shared with everyone else. So you can't really use these for borrowing and yield farming because you can't value an NFT that easily. And that's the one thing that takes away from DeFi. So it adds a lot of capital efficiency, a lot of really, really good user experience for traders, market takers, but then it detracts from the ability for liquidity providers to also, further extend their ability to participate in DeFi. Here's an example. So traditional AMM, again, is spreading supply thin across all the range. So imagine these are different tables at a market, and they all sell the same kind of good, but depending on what the price looks like and supply, just one table will be able to kind of sell one of each product that is being supplied. But if we can put more of the product at, like, say, 2 different tables, then everyone who would like to be able to buy these things can actually get it, and those sellers would be much happier. This is kind of a boiled down idea of how concentrated liquidity works, but it's essentially just making sure supply stays at the right price to be able to be supplied. So here's an example here of how concentrated liquidity is much better for market makers. If you look at the top, we have the constant product on Orca, which has 19 million in total value locked, but only 570,000 in 24-hour volume. And that's the 570,000 that liquidity providers are earning their fees from. Now we have much less total value locked, with about 12.7 million in the concentrated liquidity pools, but there's been 6.6 million in 24-hour volume. And the weekly rewards add up to 37,000. That's 37,000 that anyone who wants to add liquidity can earn from helping as a market maker. Now, the huge discrepancy is for a few reasons. It's because the use of Jupiter aggregator, it usually routes through the whirlpool instead of the regular pools, because they're more capital efficient. If a trader wants to make a trade, they're going to get less slippage on the whirlpools. So these whirlpools see way more trade, even though they have less value locked. And to go over some things about the pain points here, if you end up out of range, like for example, the Sol USDC position, it's set for Sol at 12.58 to 12.91, but the current price is 12.37. So there's liquidity locked into this pool, but it's not earning anything. It will only earn when the price comes back into the range. On top of that, let's say there's 21 cents in yield that's been earned while that range was open, and it has to be harvested, and then the range, it has to be added back in. So you have to manually harvest your yield, and you don't get the benefit of having like the auto compounding of a traditional AMM. So these are kind of some few problems that crop up for liquidity providers. Let's take a look at how this works and function then. So again, here we are at Orca's regular pools. If I want to make a deposit, They have a great function where you can auto trade uneven amounts, so you don't really have to figure out like what's half and half, and then you just make a deposit and you're providing liquidity until you withdraw it. If I come to a Whirlpool, I could choose. We got trading volume, Sol USDC. So I want to make a deposit. I could do some preset ranges. So this would be a smaller range. This would be a wider range that has a lower APY. But if I could do a custom range, and I have to essentially set my own price ranges, what I think the price will be for a while, or I have to reset it every time the price changes because I'll be out of the money. If we see, choose an amount, I have to add like some amount that balances up, and I have to do this every single time that I want to like make a new position. And we can look at positions that already exist that I've set up before. These are just out of range, and they're not earning. All right, you can see what other people have put in actually. So there's a lot of liquidity around the current price, and there's some spikes here outside. These people are just waiting out of the money to get back into it. And so the thing that Camino does is it automatically balances and sets these positions for users. So the experience is akin to the traditional AMM, or Uniswap v1, Uniswap v2. The ranges have been automatically set, and they're visible. You can deposit either a single asset or both, and it will auto swap uneven amounts. And that does everything for you. So all of these steps that you'd have to take in order to like provide liquidity here, you don't have to do. You can just sit back. It also auto compounds your fees, and you can earn rewards as well. So it's a way that like you could do liquidity mining as a program. So here we have like ST Sol USDC. There's 30% of this comes in LDO rewards from Lido. But if you look at the top performing ones, this is all just from pure trade fees. This number will change according to current volume, and that's just depending on how much people are trading. And so it's up to market makers to decide if they think people are going to be trading a lot of USDH, ETH, or a lot of Sol and Dust, and if it's worth it to enter the pool for a long while. I mean, there's definitely like different ways to look at market making, but this just makes it incredibly simple. Like if I want to do a pegged strategy, like a stable strategy, these are two stable coins for like 4.64%, 1.45%. They're much lower, but then I don't have any risk of permanent loss or the price movement from the market. And we also have vaults with just Sol and ST Sol. So ST Sol is liquid staking token from Lido. It goes up about 6-7% APY, as it's the derivative token of Sol. So it earns from staking. And then you have ST Sol, which you could use for DeFi. And yeah, the rewards here are pretty fat in LDO, but often this could be much higher during certain periods where people are trying to get out of the ST Sol. Yeah, it's really just like a one-click solution. So you just have to put in how much you want, press deposit, that's fine. And in your wallet, you get a K token. So before, if you set up one of these Whirlpools, if I check the portfolio, okay, so I've got this. If I want to withdraw on burn my NFT. So I have an NFT, it's not really composable. But for example, on Hubble and previously on Solend, you could borrow against your K token. So this is the token that you get for providing liquidity through Camino, and it's composable across Solana DeFi. So it could be used just about anywhere that wants to take it as collateral, and it represents your position here on Camino. So that's a good nod towards composability there. and it's a major improvement to user experience. So like some questions, why would we manage it? It's because, well, central limit order books take up tons of precious compute space and CLMMs don't. And it looks like there could be a future for central limit order books. Like Serum on Solana definitely was working pretty well until the FTX blew up and they figured out there wasn't a multi-sig behind the contract, but it's now being rebuilt as a community-led initiative. On the other hand, I mean, you do need something like a CLMM. They both work on different sides of the market. Like a CLOB is a order-driven execution model, and a CLMM is a quote-driven execution model. And I think there's enough demand for both, especially with arbitrageurs and the the kind of profit they make from a CLMM, and then just the user experience of a CLMM as a market taker is really great. So they'll probably stick around, and if you want people to use them, you need to have liquidity provided. So managing it is going to be a much better situation for liquidity providers and market makers. That's it. Yeah, CLMs have too high of a barrier to entry, and we want people to be involved in DeFi, so we got to make it easier. The efficiency is definitely better using quantitative analysis and managing these positions according to like when's the best time to rebalance and when's not. Also, Solana is an incredibly capital efficient network, so these rebalancings can happen all the time. It's not going to cost dollars. It's going to cost less than a penny. To compound, to set ranges, all these things can just be automatically done for people faster they can do them. Yeah, we're increasing composability because, again, like it's lost to essentially the NFT receipt style of concentrated liquidity. And new strategies. There's a lot of new strategies that can essentially be used with concentrated liquidity and automation. Some delta neutral strategies, especially with the composability between borrowing, the base layer DEX, and an automated liquidity management tool. All right, so that's about all I have to say about that. If you want to see some more resources, we've been writing a lot on blog.camino.finance, and some recent things like a market maker mentality, like so how to think about like a market maker. We've been publishing a data report, step-by-step guide, but there's some more things about market making and essentially the why DeFi needs an optimized liquidity layer, and more stuff about concentrated liquidity here. So we'll be constantly adding more information here if you're interested about concentrated liquidity, because that's pretty much our big game. All right, that's all. If you have any questions, I'd love to hear them.
Okay, yeah, great. So, Bowen, so do we have any question from Camino Finance? Hello? Hello. I think I can hear you. I can hear the voice from Bowen. Yeah. So how about you, Brandon? Can you hear?
No,
my
voice?
Yeah,
I can hear now.
okay.
Okay, I think I mute my
now.
question. Wow. So I'm gonna. Yeah. Thank you so much. For giving a really great improvement you made on the. First question is that why build on top of Orca?
Sorry?
You actually build the pool on top of Orca.
Yes. We built it on top of Orca. It's a desk agnostic tool, though. It could be built on other concentrated liquidity dexes. Orca is open source, and so that's the first logical spot to build.
So in terms of like, how do you see like the multi-chain war gonna be look like? was like on top of Ethereum, and there's kind of building on top of BSC, and also how Camino goes in the future through this kind of
You're cutting up, but let me try and see. Did you ask how is Camino going to work in a multi-chain environment?
Yeah, so like we're going to deploy in the next Solana ecosystem.
We're not looking so much to deploy on so many ecosystems, but looking at the growth of one layer one and what can happen when you have composability on a layer one. Even when you get into layer two or just bridging, you're just dealing with interoperability and the passing numbers back and forth rather than having a trustless state. And so having one trustless state is something that could really do amazing things. Yeah, like there probably will be a very big multi-chain future. And there's these ideas of having, app-specific chains. But for now, like there's a lot that composability can actually add to DeFi and create value with. So the focus here is building on Solana and working with other projects to see how far composability could really go before it just becomes like a end of the road for that. I think we saw DeFi composability exploding on Ethereum with DeFi Summer, and it hit a pretty hard roadblock with scalability issues. And as people moved on to different chains, then projects and builders are liquidities in a bunch of different places, builders are in different places, and no one can really build on each other's things anymore because, let's say, Avalanche can't talk to Polygon, and they can only send assets back and forth.
Gotcha. Maybe my connection got cut off a little. Maybe it's lacking actually. The future goals you're opening up with, how do you attract right now? So in terms of the token parity with also the target audience base you're looking forward to attracting.
Again, you're cutting up, but it's like, what target audience are we looking to attract?
And also, what audience are you trying to list the vote of it?
I mean, anyone who wants to participate in market making, anyone who's interested in DeFi. So from retail up to institutional, this is a tool that could be very helpful. Because if we look at like DeFi primitives that exist right now, there's like so many new things that we have, but like let's look at the stuff that creates value out of economic activity. So borrowing, lending, and trade, and as a market maker, making fees from helping facilitate trades is huge. That's probably like the most legitimate source of yield. And if you talk about real yield, like we're paying people to use DeFi because there's a token that's given as a reward. Can that happen forever, or when does the model become one that is very based on just the economic activity? So if retail, really got burned by Terra, the collapse of Terra, and that wasn't real yield. That was yield supported by marketing and Luna tokens being pushed into UST and then dispersed for that solid 20% APY. And that we saw them have to re-up how much was being put into the anchor treasury in order to be able to pay that yield. And that just exploded. It's just fundamentally unsound. But if we're building tools that help optimize, like taking advantage of earning real yield from like real situations, not printing things out of thin air, if the service is provided, then people pay a fee for it. And something a bit different, again, I didn't mention, but like a constant product like for a CLMM versus an order book. So for an order book, a market maker is making money on the spread because they're buying lower and selling higher, but they just want to be buying and selling constantly. That doesn't really happen so much in a CLMM or a CPMM. It's just a fee. So the fee represents the spread, a higher fee for a larger spread. There's more risk if you have a larger spread. It shows that less people are buying it and selling it right away. Spreads tighten up when more people are buying and selling. So things like stablecoins are low risk and they have a low fee structure, but more volatile assets have a higher fee structure. And if people are willing to hold on to these volatile assets for a while and they think that they're going to grow in value, then, I mean, a treasury management tool is great. It's a way that you can have like these assets you want to long. And if you're an institution, you're going to be making yield on something. If you swing trade, you might just shoot yourself in the foot, but you could be holding something for a very long time by two correlated assets that are not pegged. So let's say like ETH and BTC, we're going to assume that both will rise and fall along with the rest of the market. So they're somewhat correlated, but they're not pegged to each other. And they could be long-term holds that you can essentially increase your holdings with as you provide liquidity. So, I mean, there's use cases for, I think, the retail, because everyone doesn't have 24 hours to watch their concentrated liquidity positions, and there's use cases for market makers who do, because they don't have to spend about a good 5 minutes setting things up, multiple clicks, clicking their wallet. They can just deposit in a Camino vault and withdraw it. I like to think of it as kind of like we've had this new innovation, and in technology you have to find improvements so that they're like easier to use for everybody, or that they do the thing that you really want them to do. Right now it's just concentrated is such a kind of difficult thing to do. But we do see how much in fees it can and how much volume it takes up. So there was this paper written 6 months after the Uniswap v3 came out that showed that like maybe 49% of people who were providing liquidity were earning a profit, but everyone else had a hard time figuring it out. So when you have something that this powerful and is definitely generating more trade volume and more fees for trade, but people are not making money from it. Also, you know, market conditions could be affected by that too. There's a bull if you just held it instead of market making with it. Who knows? It's just it shows there's a lot of room for improvement. The technology's gotten better, but like we need to find ways to better handle it.
Great. Sorry, so that's and then Bo, you can take it from here.
Yeah, sorry, you broke up again. Can you guys hear what he's saying?
Okay. Yeah. So Bowen, he got a fever, so his cough is not very well, and well, okay, and that's great. Actually, one of my question is from my understanding, the Camino Finance, there's no new AMM formula or AMM innovation, and it's more financial engineering of improving capital rate utilization. Yeah,
there's some math, but it's our secret. It's like what exactly thing we can't share about that. You know.
Okay, got it. Yeah, because
you know, figuring out exactly like how to do this stuff is essentially the difference between like us and a competitor. You know.
Yeah.
And yeah, we are looking at that stuff. So there's definitely like a system, but it's not something that's essentially like entirely public until maybe open sourcing, but that's not happening anytime soon.
Yeah, yeah, understood. But from the financial engineering, is can you explain more about the durability among the OCA, Camino Finance, Jupiter, Solon, and Hubble? Because you mentioned these 5 protocols. So what's the composability among with each other?
Well, let's say so composability is the ability for like the smart contracts to call each other and trust each other's to work. And so Camino is using multiple layers. Let's say like Solana is the base layer, and on top of that you have stable coins. So like there's USDC and there's USDH, which you can borrow from Hubble. And the fact that these two can be interchangeably used or put in the same liquidity pool on Orca, that's composable. Like I can't take USDC from Avalanche and put it into an Orca pool, but I can have to change it into USDC on Solana first, because there's a code that like talks to each other, I'd say. It's like the Tower of Babel crashing, and we have multiple languages, but there's one language spoke on Solana. So let's say like we have assets like USDH, USDC, in order, it's exactly like what happened with Solet BTC. That's Bitcoin that's wrapped by FTX, but it's wrapped so that it can be composable, right? Otherwise, like Sol tokens are like the main token, and then there's SPL tokens, and since they all speak the same language, they get to be used in Orca. And then Jupiter can find the best routes for swapping, and goes from multiple dexes, seeing what's the current best route for the amount of tokens you want to swap. So like, because Jupiter can talk to all these different dexes at the same time and find the best route, Camino can also do the rebalancing through Jupiter. Also with ST Sol, so Liquid Stake Sol from Lido Finance, instead of swapping for ST Sol when users deposit Sol, we've now integrated an update where the Sol will be deposited with Lido for ST Sol. So this increases the amount of staked Sol. As you know, Solana is a proof of stake network, and it depends on like Sol being spread to different validators in order to increase the decentralization of the network. And Lido finds the best validators to give it to, and like highly qualified validators that are outside the super minority for the increasing the Nakamoto efficient of the network. I think right now there's about 30 different parties who'd have to work together in order to overtake the network. And as like Marinade and Lido work and give you liquid staking tokens using DeFi, they're increasing the stake. And then there you go. You have another composability right there. So they take your Sol, they stake it for you with deserving validators, and give you a derivative token that you can then use in as for borrowing. You can borrow against ST Sol on Hubble. It was quite popular on Solon for a bit, and you're essentially like doing a lot. I think there's about 6 different like compositions right there. Just if you look at one vault on Camino, maybe Sol, ST Sol, working with like multiple smart contracts all working together. No one has to do it. They do it themselves. Putting together money Legos, as they say.
Yeah. Okay. So, Jimmy, I think it's your time. So firstly, do you have a for Camino Finance? And then you can start your own speech.
Yeah, thanks, Brandon, for the introduction about Camino Finance. I agree with most of the parts, especially about the concentrated liquidity AMM, and also how to build on top of it to increase and improve the capital efficiency and to help to manage the liquidity and more fees for the LPs. Actually, for Izumi, we are doing similar things on EVM compatible chains, but we do it in a different way. Yeah. So shall I start my part, or or I need to wait for more time wait for you for your time? Cool.
Yeah. Okay. You can start your speech now. Yeah. I missed your words.
Okay.
Start your speech.
I hope my connection is good, and glad to be here. I'm Jimmy, the co-founder of Izumi Finance and happy to be here to introduce a little bit more about Izumi Finance, especially our new DEX Easyswap. Actually, after we have learned something about from the concentrated liquidity AMM from Brandon, I'm very happy to be here to share more ideas about our DLMM, that is the discretized liquidity AMM, which is a bit of different from Uniswap V3 or other used the concentrated liquidity AMM. So what is the DLMM and how could we build it to build the first AMM-driven order book DEX on EVM compatible chains? Here are some details. Okay, give me 1 second. First, I will introduce a little bit about our math behind, and also some basic ideas about how do we design the order book together with AMM, that is the DLMM. So we want to build the next level Binance in Web3 decentralized way to combine the order book together with the AMM, that is have the user experience from the you could trade like trading the Binance, but also trade like in the Uniswap in the same time. And all of them will, all the liquidity are existing on chain, very safely kept, and also to get a shared liquidity for each trading pair to get the liquidity providers very profitable and efficient. So the basic idea of it, if the first part is to combine the order book and the AMM together. So we design a peer-to-pool order book model. That is in traditional ways, especially when you trade on an EVM compatible chains, the gas fee is not cheap. So in that case, actually, if you trade in a traditional order book model, when you swap or when you want to buy or sell some tokens, your order will be matched with other individual tokens, which includes the ranking and the matching. This kind of the very gas confusing process. But we redesign it into a peer-to-pool model, just like the AMM. That means you don't need to trade with other individual orders. Instead, you trade with a pool together. So that helps to save a lot of gas. And meantime, we also use AMM model for market makers to save gas when they want to trade on the order book DEX on chain. So this means instead of putting a lot of orders on the book and withdrawing it, to do the dynamic rebalancing of the market making. The market makers would also use the DLM method to use the to put the liquidity into a price range to provide liquidity. So that only costs a one-time gas fee instead of adding and withdrawing liquidity all the time. So so by introducing the peer-to-pool model and DLMM, actually Easyswap could combine the advantages from the order book and also the AMM model together. So this could provide very similar user experience to the 95% of the crypto guys who just trade on the centralized exchange. But meantime, to make all the process decentralized and transparent on the chain. So by doing this, we could create something very, very cool. And the basic math function is a little bit different. Actually, we all know that from the traditional Uniswap V3 model, actually they use part of the x times y equals k curve. It is continuous and concentrated liquidity. But what we did is in a decentralized way, in a discretized liquidity way. So that's how we could make it. So let's take the blue line. This is the x times y equals k model, and the x and y token will follow the curve like in the blue line. But what we did for the Easyswap with our DLMM model, we cut the liquidity into certain price tag. That means the liquidity will not exist in a continuous way in a price range. Instead, it will exist only in certain price tag. So on every price tag, the x and y reserve will follow a linear function. That it is what you could see in the orange line. And with infinite connected line segment. This is the curve of our Uniswap. And from the another view that you could see that it is something similar like the order book. You could put your limit orders on every price tick. And meantime, you could provide your market maker liquidity into certain price range, covering certain price ticks to provide a double-sided automatic market making liquidity to earn the fees and provide liquidity for the trading pair. So you could think like Uniswap is the combination, a well-designed combination from the concentrated liquidity AMM, that is the Uniswap V3, and together with the order book model. So this is how we design it. And by debuting it on the BNB chain first, it has already been half a year very safely and fluently running. And we also upgraded it into a multiple version and to make it to be debuted on different chains. So for now, we have make it on the BNB chain, Aurora, Arbitrum, Polygon, Chronos, and etc. And also we partnership with the biggest DEX on the near, Red Finance, who made their first makes their V2 model, and which is the DLMM model. We make the Rust language version and working together with the Red Finance team to help to upgrade their traditional Uniswap V2 like DEX into the DLMM DEX. So by doing this, the best part of it is that you could trade with the swap and you could also trade with the limit orders. Actually, like you could see, like in the Uniswap Pro version, it will looks very similar like the Binance or other centralized exchange. You could put your market orders, you could get the limit orders, you could buy or sell the token at the exact price you want to sell. So there will be no slippage and no front run. Meanwhile, the liquidity behind it is provided by the limit orders market maker and together with the AMM. So the AMM and order book, they will share the same liquidity, just like what you could see in this picture. The same liquidity will be existing in one pool. So in that case, so here's the order book liquidity, limit order liquidity in blue one, and the AMM liquidity, the LP liquidity in the orange one. So all the liquidity will be compressed into one pool of different price tick. So whenever some people wants to trade some tokens, it will get across different price tick. It will fulfill the limit orders first, and then with the discretized liquidity provided by the AMM. So AMM liquidity and the order book liquidity could both help to save the slippage and also to help to provide better price for the people who want to trade. So in a brief summary, you could think about the Uniswap is a combination between the AMM and order book, the Uniswap V3, and the traditional order book like Binance model. So some of the main benefits about it is like compared with the AMM DEX like Uniswap, there will be no slippage and no front run when you're putting your limit orders, just like what you did on the Binance or other centralized order book DEX. So this could help to attract a lot of trading volumes and traders on the chain, especially when the trading fee getting much lower. And there will be also to compare with the like some FTX or other like the bankrupt CEX is fully on chain very safely and transparently. So all the money will kept in the pool or in your pocket, and there will be no way to be custodian by third party. So it will be quite safe and transparent, and you don't need to do something like proof of reserve or other things because all the things and data are transparently on the chain. And we are also looking forward to get more unique features like DID and the gas list trading. So there will be more features on the way. And by debuting the Uniswap or the DLMM on the multi-chains, we help to our plan is to help those EVM compatible chains and also like the near to upgrade their trading infrastructure from the traditional AMM to the order book plus AMM model, which could help them to onboard like millions of new users who are used to centralized exchange user experience, but who also wants to get the safety and transparency of the decentralized one. Together, Mongbo, together with the public chain and the wallet, the DAX, and the chain, together we could build something better with better user experience and betting rewards for the users than the centralized exchange. I think this is the future, especially the near future of DeFi, and how could we take over the liquidity dominance from the centralized one to the decentralized one. Yes, this is some basic introduction about Izumi. Actually, Izumi is a multi-chain liquidity service platform. We provide not only the DAX, we also provide like the farming protocols built on top of the high capital efficiency DAX like EasySwap, our DAX, and Uniswap. And you could do the liquid mining by staking the LP token, that is the NFT here, and earn rewards. This could help those guys who don't have the professional skills to earn the trading fees, as well as the incentive tokens to get it. This also shows the composability of the DeFi and how we could improve the efficiency of that. Yes, so by building it, you could trade on it with the you could trade on the EasySwap, like the swap order and the limit orders, and also you could also to use it like in the pro version, like the order book model for professional market makers or traders, and also for some people who want to add liquidity, you could choosing several token and to add it into like certain price range. So it will be similar like the user experience like the Uniswap or other concentrated liquidity ones. And this could also have to save tens of gas of the market makers for the ones who wants to make it on the chain. Yes, there's some basic introduction, and we are running about several tens of millions TVL and with millions of trading volumes every day. I think though we don't do a very aggressive marketing campaign to give a lot of incentives, but I think the product will talk. We just launched our Disrupt Pro version this week, and I hope the guys who wants to have a try the order book on the EVM compatible chains, especially could have a try and to see how it worked for you. And very happy to get all the suggestions and also the ideas from the community. Yes, there's some basic introduction about Izumi and also our newly released EasySwap Pro. And let me stop here. And Bo, is there any questions from you or from Bowen? Yeah, very happy to hear that. Thanks.
Yeah. Okay. So how are you feeling now, Bowen? Yeah. Hello, Bowen.
Sorry, can you hear me? Actually.
Yeah. It's clear now. Okay.
Yeah.
Hello?
So, well, Pancake is kind of like the default place where people see. So how do you see this competitive landscape between Izumi's future?
Yeah, you mean the landscape on BNB chain?
Yes, on BSC.
Yeah, I think that's a very promising part for us, and also a little bit headache for us. You know that the first mover has great advantages, especially on the something like the BNB chain, because for example, PancakeSwap is the second largest DEX on spot DEX in the DeFi world, and it has most of the active daily users. And many users who wants to trade, wants to swap, and wants to get some quick money will build a pool on it and also to trade on it. So this helps they already has a very large user base, and is, to be honest, I think by giving out incentives or do something like the vampire attack like Sushi did to the Uni is not a good way, especially in the nowadays or in today's market condition. So, but I think it's also a promising part for us because they already got a lot of user base. And what we did is about the assets and the liquidity. As you could see in the EasySwap and Izumi's pool, we onboard a lot of promising Web3 applications and especially some GameFis and SocialFis. For this part of the protocols, they have very long-term planning for their protocols, and they don't want to give out incentives just like some protocols did on the PancakeSwap. They just get a pool, giving out incentives, get liquidity, and rug pool. Instead, this kind of the protocols who are very cared about the capital efficiency and care about how to make the better market making plan to keep the balance between the traders and the LPs. So they will build on the EasySwap, like the ERE7, like the TinyWall, some of the largest GameFis on BNB chain, like ER7, they move from the Pancake to Izumi. And also something like the Gritty, which is another something like the Web2 startup who are building the like running club. They want to bring their millions of users on the chain. So they build a pool just with $200K TVL, but providing very good trading dips for their Web3 app to the millions of users. For now, they get like 10K monthly active users, real active users who wants to trade. So by doing that, actually, I think EasySwap has a very obvious advantages towards other V2-like DEX. That is the capital efficiency and also the flexible trading model like the limit order and order book. So for Gritty and the ERE7 case, we onboard like 20 kind of these projects onto Izumi, and we help them to design better liquidity management plan with very little financial burden, but providing very good dips and earn enough trading fees to cover their impermanent loss and their capital burden of their liquidity. So this will be a healthy and lasting model for them to build a pool. Yeah, so our strategy in the landscape, especially on the BSC, because we are not the first mover, so we are hitting the pain point of the capital efficiency and also the unique limit order and the order book trading experience for the users to onboard the unique assets and to grow together with the assets. So we are not chasing the TVL for the moment because Pancake is very big and also I think it's not competitive to just use the incentives to let them to move. It's not. I think it's not a smart choice. Instead, we grow with the promising assets. But we're also designing some like on-chain financial products, which could only be done with our DLMM model, like something like the sell put or cover call, this kind of the on-chain financial product, by providing liquidity in certain price range together with the limit orders to do the rebalance. So by doing that, we could use the spot market trading volume to give the very appealing real yields APR, like 20% APR for the USDT holders who wants to trade with the sell put strategy. So we could use it kind of the well-designed financial product to attract the liquidity, maybe to add more liquidity into EasySwap or to move from the PancakeSwap and other V2 DEX into EasySwap, because their incentives will also be it's not quite lasting. Only the incentives could not let the LP stay forever. Only the capital efficiency and the better experience could. Yeah, so this is some thoughts in my mind. Yeah.
Okay, yeah, great. Yeah, so I think the idea is very great. So I'd like to make some summarize. From my understanding, the first point I like Izumi Finance is when let's imagine the pricing power, the token pricing power from CX to DX, what happened. I think the most important solution for project that we can get rid of the the contract with the market maker. In the last cycle, when a project token he wants to go to listing to CX, and before listing, he should find a market maker and sign an agreement, and he should pay the agreement, and maybe there will be other fee from the market maker, and that really disturbs most of project, including my previous project. So if the token pricing power go to the DEX, for the market maker part, it will be more simple, right? And they can manage their liquidity on DEX, and he can manage it by himself, not rely on a professional market maker with a high fee and a high requirement of the contract. So I think that's the first thing we can see. Of course, the pricing power will go to DEX one day. Yeah, we have gone through many things. And so that's the first point I like Izumi fans, what you are building now. Yeah. Okay. And secondly, because I have reviewed Izumi's work paper. The genius idea is like you try to rotate 90 degree of the Uniswap V3 discrete liquidity, right? And so when you rotate 90 degree, it will be like all the book. Yeah, I think that's a genius idea. When you rotate 90 degree, the universal liquidity curve. Yeah. Okay. So the question from me is when the traders when he traded one token, he may the liquidity you will combine the order book and also the AMM liquidity, right? So I want to know the order. What's the order what's the order of the liquidity source? So when first, or do you have any formula to define the order of the liquidity source?
Yeah, thanks, Bo, for your endorsement. And actually, for this question, I think is very important because firstly, we want to use the limited gas fee to conduct all the computation and storage on the chain. So this is to keep the 100% composability and also to make it easy access for all the wallets and also aggregators to swap in one transaction. So there will be no deposit and withdrawal process, and all will be happen on layer one. So that makes it's very difficult if you trade with somebody wants to trade with one order. If use the traditional order book design, you need to rank the order and trade with them like you want to sell some tokens, right? You want to trade with you need to rank it from the highest to the lowest, and to try like whether this order will be fulfilled by the first order, the second order, the third order, and every order is different, maybe to be marked with an NFT. So, but doing that, it will cost a lot of gas fee because ranking is very gas inefficient on the chain. So we do it by aggregate all the price tick, like 5% put the limit orders on like to buy the Ethereum at 1,200. These 5 orders, actually, we will combine them into one, to aggregate into one price tick. That is, I will discreditize the liquidity on this price tick. This means these 5 orders will be in the AMM pool in this price tick. And when the order trade with it, actually it was trading with these 5 orders together within the same time. So it's if we use it's something like the pro rata trading matching mechanism introduced by the CME. So, but in our version, we let the users to trade with one pool instead of trade with every order. So this could help to save a lot of gas fee. And like these 5 orders into one pool, when like people wants to sell the Ethereum, when they trade with these 5 orders and fulfill these 5 orders, it will go to the next price tick. And that is how you could see, like in the curve, it is very infinite line segments. So it will go with one line segment and go on to the another line segment until it gets the desired amount or to use up the Ethereum they want to sell. So this is very important from order to order trading model into order to pool trading model, or we call peer to pool trading model instead of peer to peer order to order trading model. So this is very important, I think, design for the discretized liquidity. So we could make it to use very, very little gas fee to trade it on chain. So no matter how much token you want to sell, you don't need to match with a lot of orders, and you don't need to worry about gas fee. And sometimes we're working with Near and Aurora, we will use the gasless trading experience. That means the users, you just need to sign the signature. You don't need to even to pay the gas fee. We could pay because it's very low. We know that we use a lot of time to optimize this part. Yeah. So in one view, I think in one word, I think the user experience will be similar like in the order book centralized level, but behind it is fully on chain and to use the peer to pool model to save the gas fee. So this is the secret of doing that.
Yeah, got it. So for my understanding will be you combine the order book liquidity in a one pool, right?
Yes.
In the traditional sex, and there will be several orders, and you just combine one order and go it into one pool. When a user he trades something, if this order pool, combined with orders, if their price will be better, and then you will go to this router and to swap from this pool, this order book pool, right?
Yes, the order book pool and the AMM pool, they are together, and they are built into a shared liquidity model. The only difference between it is that one is the limit order, like that is single way. That means when the price goes across it, as goes back, your order will be filled, and you will not be traded back. And for the liquidity model, the liquidity orders actually will, just like the AMM, when the price goes lower, you are buying. When the price goes higher, you are selling. So it's double side liquidity. So the only difference between the order book liquidity and the AMM liquidity is whether it's one side, you could buy low, sell high, or it's the double side, you are providing AMM all the time. But we found a way to peer-to-pool way to build this to compress these two kind of the liquidity into one pool. So this is how we could save the gas and make the best price for the traders.
Okay, yeah. And another tough question, is also related to mathematics. And so but before my acting, I'd like to share my screen. Okay. Screen now?
Yes, I could see.
Yeah, okay. So when I try to evaluate different AMM, I will use three indicators. That slippage function, rate utilization function, like we make a trading volume derived by TVL, is we try to improve the capital rate utilization, just as Izumi fans do. And also there will the most complex indicator is the impairment loss. Yeah, and also just as Hayden Adam said, there's no single right way to provide liquidity. So my question is about what's your definition of Izumi's impairment loss? Because you mentioned that and the ARP on Izumi Finance, their APR can go to 20%, even 30%. So what's your definition of the impairment loss? Let me introduce a bit about the impairment loss definition. Because we know the AMM function is a convex function, so we can derive that the impairment loss will always be smaller than 0. So that means if no fee compensation, the all liquidity providers will got loss. And we just use the Uniswap v2 and to derive the impairment loss function details. And we define a price movement K. That means when P go to P prime and and it equal P times K. So for the K is just a price movement, and we got such a function. ILK equal 2 multiply root K divided by K plus 1 and minus 1. So this is a function of price movement, and we can make a picture. So the K means the price movement. No matter what you go up or go down, there will be below, it always be below zero if no fee compensation, right? And so that's the basic graph of impermanence picture. So we know Uniswap V2 they introduced a low is a fee, is a trading fee, is a fee potential to LP. So when he introduced the low, it's 0.3%, and we can see and the IIR curve are above zero, right? But the price range is really small. It's about four times low. So only in 4 times low, and the IIR could be above zero. That means only in this price range, in such small price range, can the liquidity providers can get return, can get some gains. So my question is that what's your definition of the liquidity providers? What's their impermanent loss? How does they can move this curve above zero? Yeah, and expand their gains. And so that's my question.
Yeah, that's a very good question. Thanks for Bo. And I think for the impermanent loss is a headache for all the LPs. So for our part, I think the definition about the impermanent loss is the same. That is to compare the results of whether you're providing liquidity towards like you hold two kinds of the token until the price change, and to see whether you get some impermanent loss at that time. So actually, I could share about my screen, and you could see. So as you could see, that this is the impermanent loss by Uniswap. Actually, it's quite similar like the Uniswap V3. And when the price is at the same time, there will be no impermanent loss. And the price goes lower or upper, there will be impermanent loss and to different rate. And you could also to calculate from our mathematics to get the impermanent loss function. I think if you it will be very similar to the Uniswap V3 because to be honest, our function is to cut the continuous liquidity into discretized one. So the Uniswap V3 curve is here, and what we did is just one infinite line segments connected. So there will be difference between Uniswap V3. Actually, by LP providing liquidity in EasySwap, it will be quite similar. Yeah. So, but for the fees, actually, we are very, I think we are more generous than Uniswap. First, there will be trading fees, and together there will be liquidity money rewards. Third, that because we add a limit order model, so the limit orders, the traders, when they trade with the order book part, some part of the trading fees will be in like terms of incentives to go to the liquidity providers. This has already been done in the near biggest DEX, Refund and V2, which we built together. So this could give more fees to the LPs. So it's very efficient one. Yeah. So the impermanent loss is nearly the same, but for the gains for the LP, they could get token incentives, they could get additional fees. So though EasySwap compared with the Uniswap V3 is very small, but I think it still was a try for the liquidity providers. Yeah.
Okay. Yeah. Got it. So your impermanent loss is similar to Uni V3.
Yeah, it's very similar.
So I think when you say the LP APR go to 20 or 30%, maybe we can't make sure it go to such APR, right? They will be an up or down or even go to below zero, right? Is it possible go to zero? You think it's a mechanic?
Yeah, actually, for the fees, it will always be positive. Whenever there will be trading, you will get the fees. But together, with a combined consideration about of the impermanent loss, sometimes, most cases, the LPs wins because you are trading with retail users. But sometimes, when the price goes into single direction, like Uniswap V3, if you do the rebalance, you will get some loss. Yeah.
Okay, got it. Yeah, and the last question is will be more in real. For example, if I am a project, right? I'm a project party, and I don't want to list six, or I don't want to pay any fee to a market maker because they are a high requirement and the fees. And now I just want to manage liquidity by myself. But it's different from Uni V2 because in Uni V2 we know we just use LP mining. It didn't work in the next cycle. It doesn't work in the next cycle because we know in Uni V2 LP mining there are many users. They will lose their money. Yeah, so they will lose their money. And back to my own scenario, I want to list my token on DEX or SEX, and I don't want to pay any fee to a market maker. And also, I think the UniV2 ARP mining mechanism didn't work anymore. So what choice can I have? And how can I manage my liquidity by myself? And how can I attract my users? And how can I serve my users trading? So that's my it's a realistic question. Maybe it's a future question. And in the next bar cycle, I may need such service to manage my liquidity and to serve my own users.
Yes, I think it's very easy to happen scenarios in the next cycle. Like you could see, like for our DAX well designed, our first priority is the assets. Like Bowen's question, we want to grow with the promising assets. So for project, for us, is totally free listing and non-custodian, non-censorship. You just add your token and you could get your pool. And also for you could have two things. You could let the users swap. You could also let the users trade in centralized order book experience and without paying anything to the market makers, because we provide automatic market making tools for you, because our DAX is the order book plus the AMM. So users could get the experience like the DAX, but actually for the projects or from the market maker side, there's nothing you need to do. If you and very high capital efficiency way to provide AMM into certain price range to provide the liquidity. And users, when they trade on the order book, they will directly to trade with the AMM liquidity because they are shared, just like what I just introduced. So it will be a win-win solution for projects and also the users, because like in the V2 model, especially in DeFi Summer, you're giving a lot of the incentives, you attract a lot of liquidity providers, but they are farm and dump, and it will become a who ran first game, like who just farm and dump, who if you don't dump, you will get hurt by other dumpers. So it's not lasting and it's not sustainable. But we see the lasting view of the Uniswap V3, because there's actually in the beginning there's no liquid money, but still a lot of liquidity providers come because of the high capital efficiency and flexible price range selection. So what we add on this feature is we also provide the limit order trading, that is the order book model, together with the AMM to do that. So it could create more fees to LPs. So if you're a project owner, you want to run it in a long way, and you want to list in any of the EVM compatible chains, you could choose Izumi. We could help you to provide free listing, automatic market making, so you pay nothing. In the meantime, we also have our incentive campaign, which could help to provide some incentive tokens from our treasury to help you to bootstrap your liquidity in the beginning, like the joint liquid mining campaign, by lighting the communities to staking liquidity into a farming protocol and giving out incentives. But this will be much easier and also useful than the traditional V2 model, because in V2 model you give a lot of incentives, but the liquidity you get is very inefficient. But we could just give incentives to certain price range, so this could get the precise liquidity you want and save a lot of budget, at least 80% of the budget. But you could also not choose that. But if you choose, we will also provide additional rewards, and you could, for the project's view, you also could just incentivize certain price range instead of the whole pool. So this could help to save a lot of budget. So we want to provide a holistic one-stop liquidity service for the tokens who wants to be listed on the chain. Actually, we have served over 30 protocols, including BitDAO, the biggest DAO, and also like the Wu network, a very professional on-chain and off-chain market makers, and many other like the GameFi protocols, like the ERA7, Tap Fantasy, like the Tiny World, and we help them to manage it and to bootstrap their liquidity in a lasting way. So this is the goal, what we want to build. And like you said, if you want to running a very like running a project and wants to issue a token, Izumi will be your free choice and with additional rewards. Yeah, and very high capital efficiency.
Yeah, okay, great. Yeah. And your question or a normal demand from project is that how can we influence or dictate our token price using your liquidity management tools? How can I influence my price? Yeah, so because why we choose a market maker? Because he can help us to influence the token price, right? So how can we use the
but I think in the next cycle, we see that like the Alameda, they could use their buying power to influence the model. But actually, when it collapses, a lot of projects also get hurt. Not only your market making your token, but also your market making fund are getting lost. So I think it's weight in the beginning, but very tough in the ending. So what we want to build is a standardized industrial level, standardized liquidity, which is very new, and to provide liquidity for your efficient and lasting way. But from the price movement, whether up or down, it depends on the market and the community, and it's different. So for the market makers, AMM level or the next cycle, I think transparent market makers level, they just provide a service and not influence the price. I think that will be some basic consensus for MM and projects. If some MM told you that they could help to pump your token, believe that they will dump it someday. Yeah.
Okay, yeah, understood. Yeah, I believe it will be the next mainstream in the next cycle. Because in the last cycle, I know a really interesting project. It's called Marriage Circle. It's a geared project, and their main liquidity will be on the Uni V2 and V3, and their liquidity is about. I think it's about $1 billion in the DEX. Yeah, and it goes to top 10, just behind the ETH, USDT, liquidity the token pairs. So that's that cycle since the merge circles, the merge circle, their main liquidity and all their price is transparent. Yeah, so I think it will go the trend will go on. The price is transparent. Yeah. Okay, great. Thank you for your speech. It's really wonderful speech, and I learned a lot from your project. Thanks.
Yeah, thanks for your invitation.
Yeah. Okay, great. Yeah. I think that's all. Bye bye.